Excellent. So first of all, I'd like to take a moment and welcome everybody to our monthly business owner call series. This is our collaboration with Kenny Shelton, Liptak, and Nowak. Our goal is always to deliver some timely information as it relates to a different topic affecting business owners. Today, that we're excited to share a little bit of time with Eqvista. We're going to talk a little bit and introduce Brayton in just a second and what he can bring to us today on the call. But we're going to focus on valuation today. So if you think back to some of the other topics that we've spent time on over the last few months worth of calls, we've talked about various things, including tax mitigation strategies, retirement plans, other things that are sort of tangible items of your business that ultimately each year we're thinking about the best ways to implement. This is something you don't implement necessarily every year, but it is something we should be thinking about. So I would like to first welcome Brayton Johnson from Eqvista. And Brayton, would you maybe just take a moment, introduce yourself, and introduce the firm before we get into some of our questions and answers?
Happily. Hi, Colin and John. Thank you for the opportunity to talk to everyone. At Vista, we have been in business about 7.5 years. Over that time, we have worked with over 24,000 companies. We operate two parts of the business, equity management, mainly cap table for private companies, but our primary practice is the valuations practice. And over those years, we've performed over 7,000 valuations on private companies, everywhere from brand new startups all the way up to pre-IPO. Companies that range anywhere from zero in value up to 20, 30 billion. Over time, we've valued upwards of, in the aggregate, about 315 billion in assets. And in the valuations practice, our focus is a couple things. First of all, I want to be accurate. Want to get the value of companies as close to perfect as we can determine, but also make those valuations defensible. And so whether that's IRS or auditors or business partners, prospective acquirers, et cetera, we want to be able to defend our valuations as strongly and forcefully as possible. And valuations, maybe to anticipate what the use case might be for our valuations, it's everywhere from M&A to raising capital, estate planning, transition of ownership, either from minority to majority or vice versa, acquisition of shares within companies, and frankly, just sometimes just shareholder matters, just straightening out who owns what and determining equitable value. And
Excellent.
that's
Well, I think we'll cover a few of those today. I know in our prep call we were able to apply some real life situations for business owners. Let's start with one place here that I think will resonate with some of the folks on the call. The misconception, I'll start with that. I'll call it a misconception, but let you go into detail, is that for a lot of business owners, when they think of valuation, they think of extremely, messy, expensive, time consuming, and you only really need it when you're going to sell your company. Can you prove that thesis wrong?
every day, yes. And it is a common misconception. People say, "Do you need a couple months, 2 or 3 months?" No, but the more time we get, the better we can perform and better we can serve our clients. But it is a misconception in the sense that it's not an extremely expensive, involved process, and it doesn't need to take months. It can take days in some cases, but a couple weeks is usually the norm. And most of that time is usually involves just tracking down maybe an important piece of paperwork, document of some or some number. But on our part, it's to our benefit, our advantage to try to clear cases as quickly as possible. So we don't like them lingering. I mean, when you're talking about millions of dollars on the line, often when you're referring to private companies, and most of, I assume, your clients who have most of their net worth tied up in their private companies. spending a little bit of money to determine the value of the company that might sway the transaction value dramatically, it's a good investment. And it's worth engaging with the client, excuse me, with the analysts, our analysts, to make sure that everything is dialed in correctly. But it's not a long time frame, a couple weeks, a little bit of money, but it's a very, in our opinion, a very good investment in trying to determine the proper value of your company.
Yeah, I appreciate that. I think we're going to spend a lot more time on some of those applications. For
Okay.
those of you on our call series who have not yet met my partner, John Bruno from Pathway Partner Services, he's the president of our service and business services company. But I just want to introduce all of you because, obviously you've seen me before on the call series, but you've not yet met
Great.
John.
Here I am. So, hey, just Brayton, just to follow up to your question. I mean, a lot of the work we do with our clients, one of the things we get is they might be doing ownership transition. It could be part of estate planning. Just could be share transition between owners. But we get a lot of pushback, like, why do I even need to do this? Like, well, we just change our paperwork, then we'll file it in a cupboard somewhere until we need it. I mean,
Yeah.
how do we respond to that?
Yeah. Sometimes you might get a knock on the door from a different party who might have an opinion about how you came about that number. So if you pluck it from the air, it might come back to bite you. Um, so we get involved in. I mean, let me just kind of characterize the larger buckets of interested parties. IRS, they kind of want to get into into people's business quite a bit if we determine a value on something. Uh, Court proceedings, whether there's opposing parties or multiple parties interested in how a valuation was determined. Other stakeholders within the company or within families or somebody that may just claim an interest. Um, so there's, as you point out, John, we get involved in the ownership transitions, ownership transactions, stock transactions within companies. And by the way, when I say companies, I'm really referring to a very broad definition. It can be an LLC, it can be a S corp, it can be a proprietorship, it can be a larger C corp, it can be a multinational with lots of little legs and arms to it. But uh, a lot of our work gets into, especially with wealthier clientele, estate planning and structuring of estates with respect to the ownership of shares in private companies. But back to your point, stakeholders are pretty important. It could be the IRS that you're needing to placate or satisfy requirements under IRC, Internal Revenue Code. And we as we're an enrolled agent, among other things, as far as among other credentials, but the enrolled agent part carries some weight with the IRS insofar as doing tax work. And a lot of our valuations are strictly tax work, tax related, and need to be acceptable in format, substance, accuracy with the IRS. So we satisfy those.
Well, let
Um,
me take a little different. I know when we were prepping, there's so many different types of valuations. We've talked about the quicker version and a little bit more detailed version, obviously, as we talk about the IRS and government entities and things. The more complex sometimes might be better for individuals like that. You
mhm.
talk, kind of match those applications. What might be helpful for more of the quicker version of the analysis versus maybe the more detailed for some applications of that?
Good point. So on the easier end, and maybe one that doesn't involve as much diligence would be when, for instance, when you want to fill in a blank as far as the value of your equity holdings on a personal balance sheet, personal financial statement. That doesn't have to be dialed into the number. It can be just somewhat close. And so, I hate to use this phrase in the valuation work because we don't determine ranges. We come to a value. But if you need a quick and dirty for a personal financial statement or something like that, for say Reg A qualification, something along those lines, that's one end of the easy spectrum. Moving all the way up to the far end of the spectrum would be something that's going to be involved in a larger M&A transaction. Somewhere in between is in a estate planning, for instance, where estate and gift estate and gift valuation. Uh, those are important IRS required processes and assignments that we receive. But while they're important, uh, and they take a lot of diligence and they have to be presented in a certain format to be defensible with the IRS, those are somewhere middle ground and a little bit more of our mainstay practice.
And I'm going to add one thing here before John goes on to the next question. You talked about the personal financial statement. I'll just
Yeah.
make some of our interactions with business owner clients. Your financial plan, right? So, what's the value of your business and when is it going to become liquid in your plan? That's an important part. And what we find, Brayton, is maybe the single most confusing point to a business owner is I don't know the value. I don't know when I'm going to work until my hands fall off. And I don't plan on doing much, but we have no idea in that plan when that asset is going to turn into an asset, right? Especially from a spending perspective.
Well, I mean, from an accuracy standpoint, that's where we come in. That's our role in the world,
Yep.
in the whole ecosystem is to put a value on it. And we can put a value on it today, a value on it in 3 years, 5 years, et cetera. I mean, obviously, the farther you go out, the less accurate or less reliable it could become. But it is definitely at least something you can chart out. As far as when, that's really up to the individual. I mean, what's their time frame? What's their exit? I started a number of companies and always think, okay, three years, I can do this 3 years. And you're sitting there for 7 and 8, and you're like, huh. But it's a matter of timing. What's optimal? And sometimes folks choose to exit at maybe less than the highest point, but it might fit with their life plan a little bit better. But that's really a personal choice. I think a lot of cases, and sometimes market driven, of course, somebody will knock on the door and make you an offer you can't refuse. And, that changes the whole timetable altogether.
Yeah.
That's
Well,
kind of fun.
and another thing, just kind of playing off that, we've talked to some of our accounts who I would kind of deem as more of our valuation educated, and they have this belief that, okay, there's the one end of the spectrum is kind of a cursory, and hey, my accountant can do that for me. And it's kind of part of my accounting services I pay, and that's just kind of a round number. And
Mhm.
then they believe that there's only one other option, and that's a fully certified one that where that misconception comes in that costs thousands and thousands and thousands of dollars. What we've learned is that there's many other variations in between. Is that something you can touch on real quick of maybe the different flavors of valuations?
Um, yeah, I mean, there's different ways to pretty much every situation you can apply different methodologies to the valuation. Um, and the use case often determines the methodology used. If you're looking at an M&A, well, that might determine the methodology. If you're looking at simply just trying to fill in the balance sheet, you're looking at a very different methodology. If there's a ton of cash on the balance sheet, again, different methodology. We use a lot of market data, and probably most importantly, who the reader or the consumer of this valuation actually is will very much determine our approach. If it's the IRS, it's there's more things at stake, and so not only the accuracy is important, how you do it and the methodology you utilize is pretty critical. I'm not sure if that answered your question or touched on where you were going with that. Exactly, John.
Yeah, I was kind of thinking, we've learned along the way that, hey, there's certified ones for
Oh, mhm.
transition of shares, whether it's
Yeah,
a 409A, whether they're
yeah,
just doing fair market value. And even
yeah.
in all those different categories, we've seen like there could be cursory and fully defensible, what we would deem certified type of evaluation.
But that gets back into who the consumer of this might be. If it's any sort of tax document, you mentioned 409As, which I'm not sure if everyone in the group listening would know what a 409A is, but it's usually performed as a tax type document to establish the option strike price for common shares, if they want to grant, if the owner wants to grant options. That and gift and estate tax or gift and estate valuations, those have to be presumed to be the consumer to be the IRS. So much higher standard, versus going back to the personal financial statement. The standard doesn't have to be as high. The consumer wouldn't be uh, a government entity. But if you are talking about share transactions or share transfers or any kind of transaction, the consumer of that, it might not be somebody to whom you're going to hand a report, but you as the owner of that equity need probably often a baseline. You need to know in your gut what that company is worth from a third party telling you that. You don't necessarily show your hand all the time, but it might be a situation where you walk into a discussion, a negotiation, or transaction already knowing what a third party has valued the company at. And maybe it gives you a defensible posture at that point. And if the discussion turns into more contentious, then you actually have a document to pull out that provides you that support in that kind of conversation scenario.
Before we go on, I just want to add quickly, if you looked in your chat, we sent a note a little earlier saying if you have any questions to put that in. We actually had a couple questions already come in, so we'll address those in a little while, or I'll integrate them, Brayton, when we can in our
Okay.
kind of normal Q&A. But I want to, come back to a point that you've said and you've alluded to, but I really want to isolate this for a moment. It can be quicker than you might expect. That doesn't mean that it's not important, right? That the work that you're doing is any less valuable.
Mhm.
So, when we think of quick or quicker, and we're not talking about months, folks on this call might be used to hearing from an accountant or another professional, it's going to take months. How is your process more efficient to the point where you're able to create a high value um, valuation without ultimately doing, again, months and months worth of work?
We know what's required for a given situation, a given type of valuation. We know exactly the documents and the information we need. Um, Immediately upon engagement, our analyst is directly in contact, and we don't automate this process. This is a very human-driven process, okay? So the analyst is in direct contact with the client or their representatives, whether it might be you guys and a CPA, an attorney, whomever. But we know how to strip out the noise. We're not going to ask for 500 documents when we need seven, and we try to ask for those seven. And in most cases, if we get all that information, we're going to come back with maybe a couple questions or none. But we know what to ask for. We're not going to nibble and ask for one at a time and just elongate the process. There's no benefit to anybody, either party in that kind of a situation. So we know what to ask for. We've been doing this long enough, and the questions to ask for an estate valuation versus a M&A situation, completely different list of questions and documents that we would need, if that answers your question,
Yeah,
Colin.
it does.
You want to change gears a little bit?
Sure.
You know, kind of traditional valuation is okay, an engagement has started, the deliverable is here's your valuation report. I understand you guys are putting an interesting spin on that and kind of applying real-time software to the process. Can you explain
Right.
what that is?
Yeah, I could use a visual here, but just to give you an example or to explain this, what John's getting at is we have changed the process a little bit. And as I mentioned just a moment ago, we bring the human element into it from an analyst standpoint. And and what that involves is a dialogue. And so when we request documents, then we get questions, exchange a few questions and answers with the client. We'll come to, we'll do our analysis, of course. We'll come to a summary valuation, then we'll go to a draft report, and then we'll go to a final report once everybody is in agreement on all the foregoing. Um, that's a standard hard copy, one-time type valuation. If it's a somewhat transactionally related valuation, it's a one-time. Here's the number today. Okay. We do something a little bit different also that John's referring to, and as I'm pulling it up over here, I'm going to share a screen. Does that work for you, Colin and John, for
Yeah,
this?
please.
Okay.
Works great.
Excellent. Excellent. Excuse me. Let me. Okay, now I'm sharing a screen. What I'm sharing here is something that Eqvista created. It's called real-time valuation. It's a reflection of the fair market value of a company. This is an always-on, hopefully always accurate fair market valuation of any given company. We've done this on now over 10,000 private firms. A lot of the companies that we work with, um, when they provide us, this is not the case. So this is not a company that we have dialed in information because I wouldn't want to share that. But this is information that would be reflective of what's available for us to work with in the public setting. In other words, this company raised public capital. We picked up those data points off the public, environment sphere and determined the value of this company at, well, in this case, nearly a little bit under 12 million. The interesting thing is this is very similar to what all of our viewers would be familiar with in a public equity, where you're looking at day-to-day variations, and you can change the time scope and so forth. But what you're seeing here in that little box as I scroll over is the day-to-day variances in variations in the value of this company. We can dial this in extremely accurately as we would in a one-time report. We can do this in effect every day on an ongoing basis. And how we do that is we determine the value of the company in and of itself with respect to its peer group, with respect to the comparables that we're able to determine, the performance of the company itself. But when you see these variances, we might not be getting updates daily from the company from a financial performance standpoint, but what we are getting daily is movements in what we determine the comparables and peer set to be. And so when these say this was an AI company, if we're watching the variances in how the public markets are tracking AI, well, this company is going to live and die on alongside their peer group. But this is truly a fair market valuation. I have conversations with clients every day who wonder how we got all this inside information when we're actually using, very public information. But my suggestion to them is become a client and have this become really accurate. And I'll stop sharing at this point. But this is something that I think only our company has been able to do for the entire private company market. As you guys are visually familiar, this is something pretty common as far as public equities.
Yeah, I want to do something real quickly on this too, is you sort of there's some questions out here. Again, I've gotten a few more too, so that's wonderful. And thank you for submitting that, everyone. Just explaining the relationship between our firms. So part of the question, how do we talk to Brayton and how do we get a hold of these guys? The answer is give us a phone call. We're partners together and do a lot of work together on current situations. We're happy to share with you Brayton's contact information. And again, we do work together on this work, and you can tell the depth and breadth of what they do in terms of the valuation side themselves. So happy to share that. We love to engage with everyone on the call or maybe watching the recording afterwards, and just how that works. One of the questions that came in, I love the way this was phrased. What's something that business owners typically misunderstand the most in their business valuation?
Ooh, that's interesting.
Yeah.
It's what you don't know that we end up oftentimes help open the eyes of founders and business owners to. Uh, it's easy as an owner. I've been a founder several times over. It's easy to remain somewhat myopic and maybe not see the forest from the trees because you're operating your business. You're in the trenches every day. What we do, we're a third party. We step back very, dispassionately, look at the landscape around the company, the sector in which they operate. We look at the trends, the movements in that sector. We look at geos and so forth. I think your question really comes down to, Colin, just our objectivity. We're not focused on a single operational thing that's been frustrating and you're trying to go to market with it and hit your buyers with that's just one component, but that can preoccupy a founder and a business operator. We're looking at a bigger picture and putting everything into context and dialing in on an overall value. Sometimes it has qualitative elements, obviously quantitative more so, but it's sometimes the qualitative elements that we might make as observations that we can start to can impact evaluation considerably.
I want to ask the other question that came in here before we start to sort of put a bow on some of this. Um, we got last minute valuations before a deal. Now, we've personally seen this multiple times where an offer comes flying over the fence and it's, hey, here's a number. And the business owner or founder says, wow, that sounds great, with absolutely no idea, right? If whether or not this number is palatable or not. You kind of touched on it earlier, right? Being that third party, maybe, you know, stepping back for a little bit and taking a look at things. You mentioned before that having a little more time is better, but that last minute offer that comes over the fence, how does that process work for that business owner who gets so excited about that and then they have to maybe step back and put a little water on that?
Well, first of all, I'd say take a breath
Yeah.
because there's always some fine print behind the number. That's just an easy one. But the to be forearmed is the point sometimes. Like what I was just showing you, that'll keep you informed as to the value continually, not just 6 months ago when you had a report done, or 3 months, or 2 years ago. Things can change pretty quickly. This could be a good way to keep a pulse on what the value is on an ongoing basis. But in terms of engaging a group like us, it's always helpful to do in the pre-planning process or in your advanced planning process. Yes, I get the hair on fire calls on Friday at 5 o'clock and saying offers, I just got a term sheet and I have to sign it by Monday morning. I can spin up what we call our tiger team, like the firefighters, they drop in by helicopter. Those guys, we can do it. I don't like to do it. Things hurried are never perfect or as perfect as they could be if you do some work in advance. But um, uh, is it possible? Yeah. The more time you get, the better, both from accuracy and just identifying really all the potential pitfalls or things you need to consider. In the case that you just outlined, Colin, by the way, we often get term sheets and people saying, give us an idea where this is. And it actually is helpful. I think we would like to put a value on a company irrespective of a term sheet, but in practice, oftentimes it comes into the picture once we've got a solid idea, and then we can opine on, how it aligns with that offer. So.
Yeah.
Um,
Excellent. Thank you.
Are we in the questions, or we just kind of, I guess how are we on time? We're a little bit, we're near wrap up,
Yeah,
right?
yeah, we're just about there, Brayton.
Yeah.
I think from our perspective, the questions that have come in so far, a lot of it is really about the business owner understanding kind of where their role in this is, right? And this understanding piece. So I'll ask the last question that came in here before John gets to our final takeaways, and just ask it this way. You know, there's discretionary cash flow, and where people think about this and say, I'm going to invest in this because it's going to help me, and it's kind of maybe not on the horizon. give me one answer on why somebody should pause today and say, look, I'm going to do the early planning process today and invest in my business to understand the value before I go down that road, and get an offer, unsolicited offer one day, or want to do the estate planning or whatever. Just help me out on that one, because the question here really is, we're not going to ask for numbers or prices or other things. That's the question here in the box. But really, I'm asking it to you this way. Just give me a little support on why somebody should maybe make that capital expenditure this year, and understand the value of the business.
I want to give you an example that will hopefully answer your question. Had a client call me. He said, I think I'm going to be getting some offers soon. And here's the range that they're talking about. I listened to this. It ended up being a 2-hour conversation on a weekend with a potential client. And I think he's all over our website somewhere. I can't remember where we have his reference, but he was going to be fielding offers in the 30 million range. After our 2-hour conversation, that was just not comporting with my view of things. We spent 2 weeks, and he was able to hold off the potential suitors, buyers, and we came out to a value of 303 million. That turned out to be approximately what he ended up selling for. 10x what he without any, he said, look, I mean, the guy, one of my favorite clients of all time, just salt of the earth guy. He would have been fine and set for life at 30 million. He's set for a few lives, now, and that changed his life. His one comment to me is, if I had only known longer in advance, I could have made different moves in my life. And he didn't say those exact words, but that's essentially what he was getting at. Like, if he'd known that he wasn't worth 30 but worth 300 all along, he would have developed a business differently. He would have. I mean, look, he didn't look a gift horse in the mouth. I mean, that 300 was pretty nice, but I had planning, and just never know. You never know.
Yep.
Yeah, well, and to that point, we see a lot of those examples to the other side, where the
Yeah.
business owner doesn't do a plan because they have a mentality of, hey, I've done this for 30 years. I know what my business is worth.
Yeah.
And the final hour, we may help and get involved, and the number is the other direction. And they're out of runway at that point, and it just changes things. So, I mean, I guess just to wrap all that up, what takeaway would you provide to a business owner? It's probably touching on your example, but a kind of summary takeaway, and
Yeah.
also, how do they get started?
I look, I've started and run a lot of businesses, and one thing that is invaluable is knowledge, like knowing something about your business. I mean, any one of us knows what our balance sheet looks like, operational balance sheet, knows what our P&L looks like. The value is just another data point, but there's no point in us creating businesses unless we're creating the wealth and have knowledge of what that wealth is. It might just be a small fill in the blank on a personal balance sheet, but it's the whole reason we do this. And to know the most important number, like, we all wake up, we know what's in our bank account, or generally. Um, this is a bigger number, and it's probably the most important number. How to start? Pick up the phone, call Colin and John, and they'll get you to me. All right.
That's
And
excellent.
it's all about a conversation. I can relate to a lot of maybe what your clients live through and are in the midst of. I've been there. Happy to share war stories and see if we can be of any assistance anytime.
If you're hearing this today, you're interested in learning more, to Brayton's point, give us a call. We're happy to make the introduction, and again, share a little bit between our two firms. For those of you who are maybe listening today or going to view this afterwards, don't forget, May the 13th is our Buffalo Business Summit. That's at the Buffalo Club. It will be in the afternoon from 5 till about 8 o'clock. Registration starts at 4:30. We'd love to have you there. We will touch on valuation. We won't unfortunately have Brayton with us. It's a long trip for him to come in for about 20 minutes of talking time. But we will talk about valuation there, and certainly we'll share more of what you heard today in person. So again, we encourage all of you to join us in person if you can at that event coming up in a little bit. So I'd like to first of all thank you, Brayton, for being a part of this.
Thanks for having us.
On behalf of John Bruno and myself and all the folks at Pathway Partner Services, we're excited for what's coming next, and we hope to see you at the Buffalo Club.
That's right. Thank you.
Thanks, everyone.
Thanks, everybody. Take care. Bye-bye.
Be well.